yourselves, if you could also include how you got involved in crypto and then what each exchange is doing in the crypto space. Ron?
My name is Ron Bernstein. I work for Coinbase, and we are investigating derivatives trading in a couple of different ways. One of those ways is decentralized and DeFi, and the other is more traditional. My background is in trading for more than 30 years. I've seen 3 evolutions of trading. To begin with on the open outcry trading floors, and then saw that morph into computerized trading, and now very fortunate to get to see how crypto and blockchain and new technologies can impact that. My company was bought by Coinbase in May of 2018, and it's a decentralized slash non-custodial trading platform for cryptocurrencies.
I'm Tom Chippis. I'm the Chief Executive Officer of ErisX. ErisX is launching a spot and a derivatives crypto exchange and clearinghouse. I came into crypto after a career in, originally in fintech and then running large global trading businesses for Citi and Barclays. And we're excited to launch physically delivered spot crypto coming very, very soon, and subject to regulatory approval, I guess a traditional futures exchange with the DCM and DCO, which will be coming out later on this year.
I'm John Dieters. I head strategy and multi-asset solutions at Cboe Global Markets. We, after a long time evaluating and monitoring cryptocurrencies, we launched the first regulated futures product on Bitcoin on a U.S. exchange in December of 2017. And we've watched that product grow over the course of the past year, and have really developed a deepening appreciation for the space.
Tim McCourt, I'm Global Head of Equity Index and Alternative Investment Products at CME Group. So I look after the global equity index benchmarks such as the S&P, Dow, NASDAQ, and Russell index families. And alternative investments, which at CME include both commodity indices and cryptocurrency. And how me and my team are involved in cryptocurrency is we have a suite of pricing products. So we have the Bitcoin reference rate and the Ether US dollar reference rate that we maintain with our partner crypto facilities out of the UK. And then on the product side, we have Bitcoin futures that were also launched in December 2017, which has gone reasonably well so far. I'm just kind of excited for today's conversation and look forward to your questions.
Hi, everyone. Afternoon. My name is Adam White. I'm the COO of BACT. BACT is the new venture supported by the Intercontinental Exchange that's going to launch the first, our first physically delivered future for Bitcoin. Prior to BACT, I was at Coinbase for the past 5 years. And at Coinbase, I looked after our institutional products, including our exchange and coverage and other groups.
Great, thank you. All right, so I will direct questions to each of you individually, but you should all feel free to jump in after if you have thoughts you'd like to share. And then I'll reserve 10 to 15 minutes at the end for audience question and answer. All right, Tim, I'm going to start with you. Can you give us an idea of who is currently trading in the crypto futures markets and where they're located geographically and kind of the time of day that they tend to be trading?
Great. I think it's a great question, and as many of you are familiar with, launching new futures, let alone futures on kind of a new asset to the to the ecosystem such as Bitcoin, is a challenge. But some of the things that we're pleased about is the customer participation or the market participants that are showing up is fairly balanced across the segment. We have a fair amount of proprietary trading firms, liquidity providers, but you also have traditional hedge funds, some participation from the buy side, some retail in the mix. So it's very healthy in terms of the balance. What's been interesting to watch, though, is I think in response to the cryptocurrency ecosystem continuing to blossom, is you also have the advent of crypto-only hedge funds or crypto-only trading firms or crypto-only CTAs, which are maybe new firms, but they're participants that have kind of come up in the industry the last few years, a few decades, now applying what they know from traditional markets onto new and exciting markets such as Bitcoin futures at CME. And what's interesting to watch, and I think what we're proud of, is when we look at the geographic breakdown, about 30 to 35% of the volume comes from outside of the U.S., which is above the exchange-wide average at CME Group. And to have that in a new product is fantastic to see. And then when you look at it by time of day, what's interesting to note is about 50% of our volumes occur in the Bitcoin futures contract before the U.S. traditional cash equity markets open. So the fact that it's balanced and almost split between non-U.S. and U.S. in terms of volume is a unique characteristic of the product, and I think speaks to the global demand and interest in Bitcoin.
Thank you. You know, John, I'm curious, are you seeing similar geographic kind of where people are trading from and the time they're trading?
We have. It's remarkable when Tim was describing the stats. It's very, very similar to what we see in our market, and it's one of the things where we've learned a lot in the year plus since we launched. You think about, brand new futures product, really first in the U.S., but kind of the first in the world in a truly regulated marketplace, and there were a lot of unknowns. Among them being who would participate, from what parts of the world, what types of market participants would move first, which would be second movers. And so we really are, we love that fact pattern that the market participants really come from all over the place, a lot of them in Asia, that it's a diverse set of market participants. To be candid, there are still quite a few large-size institutions who are connected and ready to trade but don't. And I think that's just a factor of the relative immaturity of the product set. But we've learned a lot of other things, how they price. We've learned what a futures term structure looks like, but nobody knew that before. So it just highlights how new this whole space is and how much there's left to learn.
Yeah, it does seem that they're, and I think the learning curve is definitely getting better, because I know we wanted to trade Bitcoin futures, and our prime, I mean, the amount that we had to put in for excess capital just for the privilege of trading Bitcoin futures with the prime we had been with for like 15 years was kind of shocking. But that has all kind of evened out since that time. I feel like.
Well, refer them over to one of
Yeah.
We'll fix it.
Well, interesting times. Let's see, Adam, I was curious, where do you see price discovery currently, and where do you expect to see price discovery in the future?
Yeah, I think this is really fundamental to what Bakkt is bringing to the market, is that right now we look at price discovery happening primarily on the cash markets. And those cash markets are kind of bifurcated between traditional OTC players like Cumberland and Circle and Genesis, but also the lit cash markets like Coinbase and Gemini and Kraken. And I think those markets are really important. We wouldn't be sitting up here today if they hadn't come about over the past 5 to 6 years. They've actually grown this market to one that's meaningful and shows a lot of promise. But what Bakkt fundamentally believes is that price discovery is going to occur in an end-to-end regulated ecosystem. And that's really what we're trying to bring to market. So Bakkt is providing the custodial service that allows ICE Futures and ICE Clear to trade or facilitate trading in a physically delivered product. And we believe having that product traded on a regulated exchange for the first time is going to be really important. And not taking anything away from the cash markets, the OTC markets, they're not exchanges with a capital E. So I think right now, most of that price discovery is happening on the cash markets, but what we're going to see is in time, it's going to start to switch into the futures market, and we hope Bakkt is going to be a core part of that.
Yeah, I think the one thing I would add is I think we're actually on the financially settled futures contract at CME. We're starting to see some of that price discovery, I think, moving to the futures market. When we look at some of the recent volume trends across some of the spot exchanges, inclusive in the Bitcoin reference rate and kind of, across the globe, is there are some days where the futures is doing more than some of the spot exchanges in terms of Bitcoin equivalent. Where we have a 5 Bitcoin multiplier at CME. And last month, I think we had a record day of a little over 18,000 contracts, which is almost 92,000 plus Bitcoin equivalent. So you're seeing this price formation happen, and as John kind of alluded to, I think with the basis to the cash markets that got fairly tight a few months after the launch, and term structures are developing. So I think people are really interested in trying to figure out what is the pricing, which will then lend itself, I think, to better modeling of Bitcoin futures and forward curves, and I think the advent of physical products and the convergence of these markets, I think, will only increase the velocity of all trading as there's more certainty and believability in the price discovery that occurs.
I'm going to jump on here, too, because another kind of evidence point of the price discovery comes in different places. We see, so our futures product settles to an auction event every month at another exchange at Gemini. And that auction event is one of the greatest liquidity events in the global Bitcoin market, at least those that are disclosed. And it's because people are participating in the futures product and want to get a convergent price. So where's the price coming from? From the futures traders or from the cash traders? it's kind of hard to say.
I would follow on. It's exactly right. But I think the challenge and what we've heard from our customers is that those cash markets are not regulated exchanges. So they have aspects of their business, like the custodial aspect of storing Bitcoin with a bit license or a trust. Those pieces of the product are absolutely regulated, and rightfully so. But when you actually look at the matching engine, the central limit order book, those pieces aren't. And I do think that is keeping some version of institutional capital on the sidelines, saying, look, we're going to be ready to enter when we see this end-to-end kind of regulated product. And I think this is great for the industry. We're seeing it happen.
Yeah, I think it's interesting, too, to watch the convergence between spot and derivatives. I think we have a lot of market evidence that the business tends to trend towards derivatives and novel structures. And I think in the way that we're seeing convergence, and as we start to find utility in crypto, it'll be interesting to see how much price discovery and hedging actually occurs on top.
It's a battle for dominance, so I'm going to battle for relevance by chiming in too. But I also think you can't just look at all the volume that's happening today and assume A, that it's real, or B, it's applicable as some of these other products come online. So it's quite obvious from a large body of data that the majority of the volume you see on many market centers, I hesitate to call them exchanges, is even real. I certainly concur with a lot of what I've seen in that regard. I'd also say that nowhere else do we have a product that is cash settled like the products that are at CBOE and CME. And then offshore, you have 100-to-1 leverage products running as well too, which is, I think, ludicrous speed, if I remember the Mel Brooks term. But anyway, what I'd say is that there's going to be definitely convergence, as you're hearing. But I also think that we're going to have a lot of moving parts, and teasing out the signal from the noise and all these changing inputs is going to be a real challenge. But it's also an opportunity for people that are trading at a different purpose, a different time horizon. So as physically delivered, as cash settled products come online, and as spot markets become more regulated with data you can actually trust, I think we'll start to see not just convergence, we'll actually start to see far better price discovery, which will feed more derivative products, and that virtuous circle will continue to roll.
And can you talk a little bit more about where you see the benefits with physically versus cash settled products? Or
sure. I mean, I think certainly ErisX is launching with a physically delivered, fully funded spot product, and that the spot markets are regulated under a different construct, the money transmitter construct. But we'll also be launching a physically delivered, fully funded futures contract as well too. And the benefits of operating that, and we're already a holder of a DCM license, so we have a license to operate a futures exchange. We're in process on our DCO. When we have the DCO, which is the clearinghouse license, we'll have the capability to be long spot on the spot side, and then be able to actually use that underlying coin position to generate a futures position as well too. Today, there's a substantial amount of friction as you go through all the gateways of, well, I'm going to take care of my spot transaction, either OTC, which is an evolving and very effervescent space to transact in nowadays, or you're going offshore and you're going from crypto to cash, then back into a derivative, and back out again. There's just a lot of friction in that trade. So our perspective is that by putting spot and futures all in the same marketplace with collateral held in the same clearinghouse, we start to bring some efficiencies, because I don't think access to liquidity is per se a problem today. I would say that to a firm that we speak to, it is the complication of moving cash and collateral around between all of these. And the fact that interbank transfers are seen as a real great development in our marketplace, I think, is not a mark of quality. So there's a lot of room to go there. So I think putting physical spot and physical futures all in the same place starts to remove some of those frictions, which should hopefully facilitate more participants in greater liquidity.
great, thank you. Switching gears slightly here. So Ron, I'm going to go over to you and just make sure that we capture the title of this panel here and talk about that. So I'm curious, who do you believe the pioneers outside of the traditional listed derivative space are, and what opportunities do you think lie ahead?
So the most valuable order book in crypto is managed by a company called BitMEX. They're domiciled in Seychelles, and they operate in Hong Kong. And the amount of notional volume that they transact is probably somewhere between 20 and 30% of daily notional. And it is the pricing reference, has the most liquidity of any order book in Bitcoin or Bitcoin-like products. And they've innovated not just the regulatory arbitrage, but also a really unique product that has economic incentives and mechanisms to keep the futures price very closely tracking some spot prices. Just fascinating engineering of a financial product.
Yeah, so on that note, Tim, maybe this is a good time to talk about how we don't really have central clearing in the crypto markets as of today. I think kind of coming off the BitMEX, yeah.
Yeah, I think it's interesting. I mean, obviously, BitMEX, I think, is doing interesting things in this space, but, the model they deploy is not the same model that participants can enjoy from central clearing and being a regulated clearinghouse and a regulated exchange. The concept of socializing losses and kind of the mutualization of risk and things like that is very different in that space, where when there were some kind of losses being handled on the BitMEX platform, we saw spikes in our volume at the same time. Because people are getting put into risk that they necessarily aren't signing up for at inception. So when we look at the central clearing model, these are the benefits that customers want. Especially when you're talking to the institutional players who are still waiting. Some of it is going through investment committees and risk committees and new product approval. But a fundamental aspect of the listed regulated venues that in the U.S. that we're looking to provide through the DCO services and the clearing services is that as a clearinghouse, we are the buyer to every seller and the seller to every buyer. We guarantee that trade, and that's not something that exists in the OTC unregulated space. So I think that's a benefit that people enjoy, and that's actually what gives, I think, a large degree of comfort to some more traditional players and institutions in making that move into crypto. So I think that's one of the largest, and I think we're kind of hearing that, from the regulated venues, that's probably still one of the original customer demands and remains as strong today, that they want a centrally cleared, regulated product for them to be able to risk manage and enter the crypto markets.
I'd like to push back a little bit on that. I think that crypto and crypto native, and certainly the future, gives us the opportunity to require less trust. I think that's the ultimate goal for decentralized technology, and I think there will be a way to either self-custodian or not necessarily rely on a lot of centralized infrastructure at some point and rely on public blockchains.
Yeah, I don't agree with that. I don't think when we're talking about financial transactions, we need less trust. I mean, I think that's fundamentally or diametrically opposed to our viewpoint from the benefits of central clearing, because one of the things that you need to manage your risk is you need to understand the rules of the road and have a degree of certainty about how those events will unfold when you need to manage said risk. So they may be decentralized, and that's certainly an attractive aspect of the technology and the space. But central clearing, it provides the trust to get market participants to do these things and provide liquidity, and you need certainty at delivery.
Maybe to Tim's point, one thing I like to differentiate is we kind of unfortunately bucket all of crypto together for the different processes or things people are doing. And in one way, trading in markets may better well be served in a centralized, more holistic framework that kind of fits in with the existing financial system, because these products are regulated. There's no way to avoid that unless you go offshore. But the actual application utility of crypto, I do think, to Ron's point, that decentralization can be powerful. So it is this idea that if you actually want to store your own crypto, you absolutely can. If you want to build an application on top of a public blockchain, you can do that in a permissionlessly innovative way. I think a lot of great stuff will come from that. But when you really fundamentally double-click on trading in markets and price discovery, I do think the vast majority of capital that's waiting on the sidelines will not come in for things like self-custody or mutualized losses via no clearing or an alternative clearing method. They are looking for this asset class to fit inside the bucket and the processes that they're used to, and that's where we're going to see the most growth.
Great. And just in talking about kind of the regulated versus unregulated exchanges or platforms, I know that at CMT Digital, we tend to see, it almost feels like a new exchange, a new crypto exchange offering once a week. So John, I think in your position at CBOE, you see a lot of startup platforms. Curious what you're seeing and what trends you're experiencing there.
So a trend is, and it's a good segue, a trend is definitely towards constructing platforms that are in one way or another more regulated or have the look and feel of an institutional platform. We're investors in Eris, and we like what Tom and team are doing there, and that's very much the theme. And then you're also seeing a lot of proposals that sort of put together the channels, the gateways for market participants to access the market. Data tools are, I think that's very, very early. People don't necessarily know what data streams to trust. So there's a recognition that will have to come, but it's not seeing as many kind of solutions there as you'd expect for a market that gets so much attention. You know, in terms of, we're at a very different place now than we were a year and a half ago when we were kind of at the height of a certain kind of mania around this space, and it's actually a healthy place we're at right now. Ticket sizes are coming down, valuations are coming down. People are crafting business models that are focused, that really have a point to them instead of trying to change the world. It's not that we didn't benefit from those grand ideas and the capital put behind them in the past. We all did. You know, that's capitalism. That's risk being put to work, and presumably everybody who invested in those platforms could afford to lose it. And when it was lost, it wasn't lost on betting on an asset. It was lost in really trying to solve problems, and in some cases they did it, in some cases they didn't. We're just at a different point right now where people have learned from those lessons, and there's a certain practicality in the market that's palpable.
Thank you. Adam, as we start to gain more regulatory clarity, I'm curious what you think the impact of that will be on markets and liquidity in the crypto space.
So I think one of the things ICE does better than most is that they take opaque, inefficient, generally unregulated or underregulated markets and bring them to be accessible, transparent, and kind of regulatory clarity. They've done it with energy, they did it with credit, and now I think we're trying to do it with cryptocurrency as well. So a lot of the work that we're doing with regulators is very much a partnership. It is not a world where you fill out an application, you throw it over the fence, and you hope you get it back so you can launch your business. It is partnering and working with regulators to help them understand things like hard forks, what a deep chain reorg is, why one blockchain, a public blockchain, may be sufficient and capable and mature enough to support while another one isn't. That's very much the approach we've been taking. And regulators are going to move at a pace at which they feel comfortable, so they're protecting their constituents, you know, the public. And to ICE and BACT, to us, we look at that as something that we are going to do thoroughly, comprehensively, and we think is a core part of our business. So we keep reminding ourselves we need to move at the pace of a startup, so we need to be in the sprint mode, shipping product, hiring people, continuing to execute. But we need to look at this as a marathon in the sense that the winners and losers of this space are not going to happen overnight. It's going to happen over the next couple of years, if not decade, as a lot of this core infrastructure comes in. And we look at the only way to getting that core infrastructure in place is by helping develop regulatory clarity. And we're in an environment right now where you have 4 different regulators classifying cryptocurrencies as 4 different things. You have the CFTC calling it a commodity. You've got the SEC calling some cryptos a security. And then you have the IRS, which is under Treasury, calling it property. So when you buy coffee, you have to pay taxes with, on your Bitcoin. And you also have FinCEN, also under Treasury, looking at it like a currency. That lack of organizational, that lack of clarity is something that we as kind of regulated entities need to work through. But we look at it as kind of core to our mission and what we hope to do well.
I think there's a real relationship between the last 2 questions that you asked. In my experience, the majority of the new exchanges, some of which that haven't even launched, are approaching another exchange that hasn't even launched about opportunities. And what I find with most of those is that they are very technology focused, in some cases wholly unaware of even being able to name one of the 4 regulators that Adam just mentioned. And what I find is that those market centers are very focused on a very Silicon Valley-esque, put the product out there, we'll figure it out later, and we don't see it as a deterrent that we have to have a banner on the top of our page that says if you're a citizen of the United States or a resident of Quebec or these 42 countries, you cannot trade here. They see that as a badge of honor, that they're launching something new and innovative and other people don't understand. And why I say these things are related is as you do engage with the regulators, and I had the benefit having run global trading businesses of interfacing with almost every global regulator, I've never met one who is going out of their way to stop someone from doing something. They want to understand. And to the points that Adam made about it being a process, there's a lot of education. And I think that in my experience talking to regulators here and elsewhere, there's a surprisingly deep amount of knowledge already out there about crypto. Very, very deep. They spent quite a bit of time. Certainly the CFTC through Lab CFTC and what have you, has been very, very forward thinking. They had the Ethereum RFI, which I think are all good steps showing forward momentum. But there's definitely a cultural discongruence, I would say, between those that recognize regulation is definitely not moving at the pace of technology innovation, but we're talking about substantial amounts of capital and people's money, and ergo, we have to go step through that process at a different pace. It's not how fast you can just ship code, but most of the regulators are probably better well informed than people would give them credit for.
Yeah, I would agree. We've had a lot of discussions with regulators over the years, and I think they're in a really tricky position. You've got this new technology that they're trying to understand. You also have a global market right now that is only 1/6 the size of Apple, one U.S. company. So it's very early. It doesn't, there's no systemic risk at this point. I think we all expect it to grow to the point where that will happen in the future, and to get smarter, regulators are thinking about all of these things now. But it's also open source technology, open to the world's entire population. So how it looks today is not how it's going to look tomorrow. So it's a tricky job that our regulators have. So I think about that quite a bit. We touched on infrastructure, and I'm just going to throw this out to the group. Adam, you mentioned this. So we think a lot about the fact that when we're trading in the crypto spot market, it's a very inefficient use of capital and coin because there's no prime sitting in the middle, right? Looking at our position on an aggregate basis, there's no one providing us financing, so we've got to leave everything across the exchange, pull it out. It's very inefficient. So when we think about infrastructure that still needs to be laid in order for the larger institutions to come in, obviously the primes are working with CBOE and CME. Do we need them to be working with the spot exchanges? When will that happen? More mature borrow lending facilities. We talked about data, trading tools, analytics. I'd love to hear the group's thoughts on what you think still needs to be laid from that standpoint.
One of the things that we're faced with is that the product itself is enabling a lot of innovation on top, but the nature of trading the thing is just another asset. And trying to connect the asset itself with the potential that the asset enables, I think is tricky and really interesting. So it's not just things like price and the traditional problems, but how to actually use crypto while it's in custodianship. Some of the new models like Cosmos was released yesterday. There's a staking component to that. So finding ways to increase utility by consumers, which then obviously makes more liquidity in the markets, which benefits us as market operators.
Yeah, and so what I'm hearing there too is that you can't just take existing exchange architecture and copy and paste it into the crypto world, because you have unique things like staking, and how do you do that? Well, obviously custody is completely different.
Yeah, I mean, there's definitely inefficiencies I referenced earlier to moving your coin and your cash around. Certainly, some of those we think are solvable with the model we put forth by putting all this into a clearinghouse. And I also think OTC market stands to benefit from some very simple innovations of being able to put up a block trade through a clearinghouse where you don't have to go through the bilateral due diligence to ensure that the other side of the trade is there, and trickling cash into a shared account, trickling coin into a shared wallet, and what have you, which is really how a lot of that happens today. But once you have that infrastructure and you have assuredness of a trusted counterpart between all of these entities, that opens up the necessary event lifecycle management you need to implement things like lending and what have you. And I think a lot of the reasons some of the primes in that haven't gotten heavily involved, and I would argue had to have their arms twisted quite heavily even to trade the products that CBOE and CME have put out. A lot of it just comes from a lack of education, but all of it also comes from the fact that the volume, as you said, is small in some of these right now. They have a lot of other things on their plate. So the innovations here can be simple. Come to a clearinghouse, for example, and put up your block through that facility. And they could be complex, all new technology, accommodating staking, what have you. But once you start to remove the risk of, if I put out money, will I get my coin? If I put out coin, will I get my money? Then all the other innovations we've already brought that have enabled safe application of risk-based leverage models can start to come into play. Right now, there's just too much sand in the gears to let those things happen efficiently.
Yeah, I think one of the things you do see in the chain of infrastructure is that new players are coming in to fill some of that gap. Like Tagomi is a good example. Right? We do some work with them and think that they're filling a gap that the traditional primes have not filled yet because of that prioritization question that raised. It's not yet big enough. It'll get there, and it'll get there as a result of demand that rises to the level where people can prioritize. That'll solve a lot of problems. So once the larger banks can function as primes, they're going to get more interested in the spot platforms. And you're already seeing that from some institutions. Again, these guys have real institutional backing. That'll sort of raise the bar for everybody, create this virtuous cycle where comfort builds, and then even more primes get into the game.
Great. Let's see, and we touched on decentralized exchanges a little bit. So I think, I'm not sure how familiar people are with them. Maybe, Ron, if you could talk a little bit about your background with Paradox and just decentralized exchanges generally, advantages, disadvantages versus centralized exchanges, which is what we've been talking about for the most part.
So decentralized exchange is basically the thing that blockchain enables. It allows people to trust less of an economic architecture to transfer risk. When it's decentralized and it's fully collateralized, for example, there's one source of truth that happens to be on a public blockchain, and those assets can be fully tracked. When you move across the spectrum to centralized, it's the product set that we're all familiar with that trades on traditional exchanges. And then there's this piece in the middle which kind of pays respect to fully decentralized, but also recognizes centralized, and that's non-custodial. And that's the aspect where your assets remain in a user's control, but the funds at risk, which you had touched on, whether or not someone's going to get paid at the end of their trade, is guaranteed by new technology and smart contracts and things like that. We don't necessarily have leverage and margin figured out in that respect, but that's kind of where things are going. So decentralization allows, an off-the-grid environment. Centralization is the thing that we know, and there's a spectrum between. The thing that I like about custodianship or non-custodial, and that's why we built Paradox that way, is your funds move and trade from wallet to wallet, so there's no waiting for your prime or to give you margin or credit. If you have the assets to take the risk, you're able to do that instantly. And I think if we continue to compress those cycles, even within centralized exchange, banking gets better, instant credits and prime covering the collateral, I think we'll have a native crypto experience, but using the infrastructures that we have.
Thank you. So we've spent some time talking about the importance of institutional investors and when they are coming in and if they're coming in. We haven't talked as much about retail investors, and obviously crypto, I think, sort of got started with the retail community. How important with your exchanges is it to have a healthy mix of retail and institutional? Whoever would like to
we think
start.
it's very important, as evidenced by, we're very fortunate to have some very large retail platforms as investors in RSX with TD Ameritrade and Fidelity and Monex, the parent company of TradeStation. So we think it's very important. And we think one of the reasons that you're not seeing the same level of retail uptake in the U.S. is most people do not want to go through a process of setting up accounts with an entity they're not familiar with to trade a single asset class. As convenient as it is to take a picture of your license and credit card from your phone and voila, start trading, I would put to you that the majority of people that trade through platforms today, such as TD or Fidelity or what have you, are doing it because they have investments of different types for different characters. What they want is convenience of access and the other feature set that those particular intermediaries provide to them. So, albeit there's certainly millions of people trading on all these other platforms, there's probably people who are really, really interested in being part of crypto. But over time, for this to grow, it needs to find its place in the broader portfolio allocation that will be made. I don't think a lot of people have their portfolio reviewed by an RIA and are told you really need to have 5% of this in Bitcoin today. That day may come. Maybe it'll be Ethereum, maybe it'll be something else. It really is the use cases develop more, then the investment case will become clearer. But certainly, RSX believes that all these intermediaries actually add value, and that's sometimes antithetical to a crypto native who says, why would I ever do that? Well, not everyone's trying to solve the same problems or they have the same ethos, but they still might want to invest in this asset class. So we think, at least what we're doing, enables those platforms to bring their customers in, whereas today the majority of those customers probably aren't willing to participate with the tools or markets that are available to them now.
Yeah, I can tell you the experience I had getting my dad with buying Bitcoin. So I think,
Did you have to give him a coin?
no, believe me, that probably would have been smarter than what we did. Yeah.
I'll agree with Thomas. And I think in order to have a healthy marketplace, it's non-homogeneous. We have to have retail flow coming inside there. Otherwise, you have institutions all facing off against institutions, trading on the same time horizon, and it becomes, I think, far less efficient. My personal thesis is that we're going to see that retail flow come less from active day traders, the kind of Coinbase retail customers of the world. I actually think the Coinbase and Circles have done a pretty good job attracting those customers. My hope is that a lot of that retail flow comes from actual utility or application of crypto. And that in many ways, customers that are using crypto should never know they're using crypto. This idea that right now I have to go out and buy some Bitcoin to go out and use it is a great first example of a use case, and we see a lot of the early adopters and technophiles want to do that. But I think it's Bakkt's perspective and mine personally as well that cryptocurrency, or maybe better said, public blockchains, are going to be most successful when nobody knows they're using them. When I walk into Starbucks and swipe my credit card, I have no idea how an issuing bank talks to an acquiring bank with interchange, and all that happens seamlessly. It's transparent to me. So my thought is that as we start to find uptake with actual permissionless innovation happening on top of the cryptocurrency protocols, and we're seeing payments and remittances and information storage and value transfer happen, that flow will ultimately be driven by retail that may come in via an institution back into the market, but it's going to be retail driven. I think that's going to be a really important step function and possibly the next catalyst for what we might see as a bull market in crypto.
Sure. I'll make another, because this is an interesting topic. I think on retail, like the fact is, this market wouldn't even exist such as it is today without retail. And so we talk about institutional because that's the next sort of frontier. And it's all the folks, the nativists, the people who really believe in the inherent unique characteristics that Ron's pointed out, the decentralized nature of the asset that's attracted so many people in these early days. All the infrastructure has to get there for more retail, and that's quite possible it'll happen. But again, it's early days. A missing piece I pointed out last year, and I still haven't seen a good answer for it, is research, basic information. It's overwhelming for a retail investor with a day job to really know what to do here, which asset, at what point, what are the trading characteristics? Is it a risk asset or is it a safe haven asset? Like, nobody knows the answer to those questions yet, and it'll come, but we're just so early.
Yeah, I think the one thing I would add from the CME perspective is retail is a critically important customer segment. In 2018, our retail trading was up about 27% at CME Group, where they traded over 660,000 futures contracts per day across all of the various asset classes and product suites. But I think this is also something where we're continuing to focus not just on cryptocurrency, but other asset classes where this is probably the first time in 2 years I could bridge both of my job functions, where we launched micro E-mini equity index futures for retail earlier this week, or announced the launch. But to Adam's point is, I think what's interesting about the retail, and it's open how you could define the retail segment, is I think what's important is when you think about futures markets and derivatives markets, a cornerstone of that is true fundamental commercial need and purpose. And I think, unlike other asset classes where that may be farmers or shippers or financial institutions, I think what's interesting to watch is the retail segment going to be that commercial provider of let's call it the organic need, that provides that persona into the mix. You need these multiple customer personas for people to trade and to disagree on price, to build these markets and take viewpoints. I think that'll be interesting to watch as well.
If I could just follow with Tim's point, this is exactly why Bakkt is built, doing not just trading and markets and price discovery, but also doing the Starbucks first use case, which is here's a way for retail commercial users to use Bitcoin, and that order flow will come back into the market. To me, it's not enough just to say we're going to invest a ton of money into market infrastructure and hope someone else figures out why we're going to use this. To the point earlier that John made, if it's all baked in this assumption that in the future it's going to be worth more, but there's no fair way or kind of ubiquitous way to value it, I think we are going to see volumes continue to flatten and the price probably to trend to zero, because everyone's baking that in the future public blockchains are going to be more efficient, they're going to be cheaper, they're going to be faster. But it requires companies building actual use cases and applications on top of that. So, I tip my hat to the Coinbases of the world that are saying we're building market infrastructure, but we're also out there innovating and experimenting and trying to do things like non-custodial exchanges and use cases. And I think Bakkt wants to do a little bit of that as well to help. I think all of our companies ultimately see more flow.
Great. I am curious if we can just go down the line. Just what are you most excited about in this space?
So I'm really excited about some of the non-custodial opportunities to borrow and lend crypto, to use public blockchains with lower levels of information being shared about users in the space to approximate all the things that happen in the traditional finance world. So you can lend crypto, you can borrow crypto, you don't have counterparty risk because theoretically all collateral is posted in a smart contract and processes unfold automatically. And I think banking the unbanked and a lot of the use cases, even dripping down to buying a cup of coffee using Bitcoin in the back end, but not even knowing that, are really exciting.
I'm biased and I'm excited that we're launching an exchange, which is just a little bit of work. And really bringing one together that brings retail, as we talked about, market makers, producers, institutional intermediaries, a true commodities market, because one doesn't exist yet today that has spot and futures that bring together all these counterparts in one place. So that in and of itself is pretty exciting, and keeping up with the names of all the new people joining ErisX is also exciting. But the other thing I'd say is that, and we talked about this actually in the comment letter we filed with respect to the ETHA RFI, we truly believe that by creating the market that we're creating, that other people will actually, and maybe it's a little bit of a deviation from Adam's comment, we're not in the business of developing distributed apps. That's not what we do. And I think that if a market center wants to compete with Visa and MasterCard and everyone else who does interchange for payments, we're going to see what happens. And I think it's seeing what blossoms out of the enablement that we're going to bring to the table for those that want to build applications powered by these cryptocurrencies, by these tokens, and giving them the assuredness that if they need more tokens on the spot market because demand for their smart contract-driven distributed application has gone up, they'll be able to get it. And if they have a global business and they don't want to be denominated in the cost of that business in terms of one particular fiat currency, they should be able to purchase futures on those tokens, the delivery at the time of their choosing. So I think I'm very excited to see the next tier of development take place. I'm less focused on the question of when's retail, when's institution going to be there, because I actually think you need the development of all these platforms and products to take place to pull them in. They need the reason to be there, and we need to leap ahead to start enabling those that are going to create those services and generate that demand.
So I think we're super excited about the technology, a little bit of a different angle from what Tom was describing, the technology of the assets themselves. So you think about, well, take Bitcoin as an example. If for whatever Bitcoin is trying to achieve, what's coming that might be better than Bitcoin? How does a thing like the unity concept affect Bitcoin's position in people's ideas of a crypto portfolio? This is kind of the first asset class where an asset can disrupt another asset. Like nothing disrupts gold. You're not. But this is constantly evolving from a technological standpoint, and that's fascinating to think about. A related topic is sort of security tokens and what you can do with crafting a security token that has automatic functions for payout and things of that nature that sit in a completely different place in the capital structure of an issuer, and how can it be crafted for a particular issuer's very discrete needs? And what does that mean when you roll forward and you think about things like rights and bankruptcy? And there's just a lot of stuff there to unpack. And since we're also a securities market operator, it's natural for us to think about those things.
Yeah, I didn't ask you when options are coming, so we'll table that. I'll ask you after.
All right, we'll get there.
Tim?
Yeah, I agree with everything that people are saying. I think these are truly fascinating developments in technology, and the things they're offering to the markets and the ecosystem is fantastic. I think kind of maybe what I just had a little bit of a different answer is I think this is what I find interesting is to be part of something like this that's building in the marketplace. It's not something that comes along very often. So when you think about trying to build new markets and help customers and market participants manage new emerging risk as it relates to cryptocurrency or how they're looking to allocate their investments and trying to build that together, I just find it personally challenging and rewarding because I don't think, I've been on Wall Street now, I guess, almost 19 years, and I think this is truly a very fundamental change, and they don't come along very often, so I think it's just very fascinating and I'm fortunate to be part of it.
I'd say by far I'm most interested in the protocol level developments that are happening to actually scale public blockchains. So taking a step back, and what we kind of spoke about is all this infrastructure we're developing is to allow trading and markets and price discovery, but it's this huge assumption that people are actually going to use public blockchain tokens, those physical assets or digital assets, in the future. And I think everyone's pretty aware that right now we've seen so much growth and adoption and interest that the public blockchains are having trouble scaling. So whether it's the number of transactions or the throughput or the stability, or things around governance, how do you actually manage changes and hard forks? Those are real challenges. So what I find most interesting are things like what Ron mentioned earlier, Cosmos, which is kind of a meta blockchain that sits on top of all the other blockchains to kind of unite them. It could be things like Plasma or Lightning, which are on and off-chain scaling solutions on certain blockchains. And to me, that's where there needs to be continued interest, but also continued development and funding. And what Ethereum recommended last week was putting a very small tax, like a fraction of a penny, on every transaction that goes to the long-term support of Ethereum developers that are actually building and improving upon the protocol. To me, if we lose sight of that and we build all the layer 2 and layer 3 pieces on top of the actual protocol, that protocol is not successful. All this is for naught. So that's something I like to stay pretty close to, and the back team does.
Thank you. I should open it up for audience questions. If we have any, we should. We have like an amazing group of people here.